There is no longer one silver market. There are two. One is the silver price on your screen. The other is the price human beings are paying to get actual metal into their hands. And right now, those two prices are blowing apart in a way that should terrify every bank, every short seller, and every person still trusting paper promises. New York is flashing one number. Dubai dealers are asking something dramatically higher. Japan is trading physical silver at levels that make the official quote look absurd. China is clearing real metal miles above the paper market. Same metal, same planet, same day. Completely different price. That is not normal dislocation. That is stress. That is fracture. That is a system losing control. And once a market starts splitting into fake price and real price, the next phase is always chaos. What happened is simple. Physical silver started telling the truth before the paper market was ready to admit it. That is the entire story. Not next month, not in theory, right now. Real buyers are paying far more than the screen because the screen is pricing contracts, leverage, and confidence. The physical market is pricing scarcity. Stay with me, because in the next few minutes I am going to show you why this gap matters, why it is widening, why the usual arbitrage is failing, and why this could turn into one of the most violent repricings the silver market has ever seen. If you want straight analysis without the fluff, subscribe now, and tell me in the comments one thing. If paper says one price and dealers ask another, which market would you trust with your money? Here is the part most people still do not understand. The number on financial television is not the price of silver. It is the price of a contract linked to silver. That sounds like a minor difference. It is not. It is everything. A futures price is a promise to deliver, a promise to settle, a promise that someone, somewhere, will come up with the metal if enough buyers demand it. That system works beautifully for decades, as long as almost nobody asks the obvious question. Where is the actual silver? The moment enough people ask that question, the illusion starts cracking. That is exactly what appears to be happening. Physical inventories are being pulled. Delivery pressure is intensifying. Buyers are no longer satisfied owning exposure. They want ownership. They want bars, coins, kilos, vault receipts tied to specific metal, not a digital placeholder floating inside a financial structure that assumes calm conditions forever. And calm conditions are gone. Look at the scale of the imbalance. World silver demand has been running above supply, not by a rounding error, by a meaningful, persistent deficit. Industry is consuming it. Investors are hoarding it. Governments are watching it. Vaults are being asked to fill promises that were built on the assumption that most holders would never ask for delivery at the same time. That assumption is dangerous. Because silver is not just another shiny asset people speculate on when they get bored. Silver is an industrial survival metal. Solar panels need it. Power systems need it. Electronics need it. EV infrastructure needs it. High-end electrical applications need it. Medical equipment uses it. Defense systems use it. Unlike gold, a huge amount of industrial silver is not sitting around waiting to be remonetized at the first sign of panic. It gets used, dispersed, locked away, consumed through manufacturing, and effectively removed from easy circulation. So when the market runs a deficit, it is not an accounting game. It is a drain. And drains become shortages when confidence slips. Now layer on top of that the geographic choke points. One of the biggest hidden truths in this whole story is that raw mine output is only part of the silver chain. Refining matters, processing matters, export permissions matter, logistical control matters. If a major refining nation tightens rules, limits who can export, favors domestic buyers, or starts treating silver like a strategic material instead of an ordinary commodity, the West does not just get a higher price, it gets a smaller supply window. That is when the price on the screen becomes fiction. Because a screen quote only matters if you can convert it into metal. If silver is supposedly trading at one level in New York, but physical markets in Dubai, Japan, and China are consistently clearing at much higher prices, the first question should be obvious. Why are traders not just buying the cheap silver and shipping it to the expensive market? That is how arbitrage is supposed to work. That is how price gaps are supposed to disappear. But the gap is not disappearing. It is lingering. In some places, it is widening. That tells you something is obstructing the flow. Either the metal is not easily available at the quoted paper price, or the cost, delay, and risk of obtaining it are so severe that the spread still cannot close. Both possibilities are bullish. Both are dangerous for the paper system. Because either the silver is there and nobody can move it efficiently, or the silver is not truly there in the quantity the paper market implies? Neither answer is comforting. This is where the story stops being academic and starts becoming explosive. If the real market is clearing above the official market, then the official market is underpricing stress, and underpriced stress does not remain stable. It snaps. Think about the psychology here. A normal investor looks at the chart and thinks silver is already high. A physical buyer walks into a dealer and discovers the real acquisition cost is dramatically above spot. That buyer then learns the wait times are longer, the premiums are rising, and the inventory is thinner than expected. What happens next? They do not become calmer. They accelerate. They either buy immediately, or they start fearing that tomorrow's offer will be worse. That is how squeezes feed themselves. The paper market depends on apathy. The physical market is powered by urgency. Once urgency outruns apathy, the paper structure starts losing authority, and the biggest players know this. Watch what institutions do, not what they say. When large financial entities begin taking delivery, when big houses stop behaving like casual traders and start behaving like they want possession, that should get your attention. Banks do not scramble for heavy metal because they like the aesthetic. They do it when they see tightening conditions ahead, when they suspect the optionality value of real ownership is about to rise, and when they know the public is still staring at a benchmark that may not reflect the true clearing price. That is how smart money front-runs a dislocation. Meanwhile, the other side of the trade is sitting on a problem that gets uglier the longer this goes on. Massive short exposure in a commodity with a shrinking pool of freely available physical inventory is not just a bad trade. It is a structural hazard. If those shorts need to cover into a rising market while real metal is becoming harder to source, the move does not stay orderly for long. It becomes a scramble. And in a scramble, price targets that seemed ridiculous one month suddenly look conservative the next. That is why this split between paper and physical is not a curiosity. It is the warning siren. Now let's talk about signals the mainstream barely explains. Lease rates. When people are willing to pay unusually high rates just to borrow silver, they are telling you that immediate access matters more than normal financing logic. Backwardation. When spot trades above future delivery, the market is saying present metal is more valuable than promised metal later. That is not what a relaxed commodity market looks like. That is what mistrust looks like. That is what urgency looks like. That is what a market looks like when participants are no longer fully convinced tomorrow's supply will be easy to obtain at today's assumptions. And the vault categories matter too. Metal sitting in a vault is not the same thing as metal available for delivery. People hear inventory numbers and assume all of it is up for grabs. It is not. Some of it is merely being stored. Some of it is already spoken for. Some of it belongs to owners who have zero interest in letting it go at current prices. So when the pool of truly deliverable silver shrinks, every extra ounce demanded matters more than the headline data suggests. That is why the visible numbers can lull people into complacency right before the squeeze. Then there is industry, the part of the story that makes this far bigger than a simple trading event. Silver is being pulled from both ends at once. Investors want it because monetary systems feel unstable, debt levels are absurd, and paper assets are starting to look crowded and overpromised. Industry wants it because modern infrastructure runs through silver, whether investors are bullish or not. Solar demand does not vanish because a hedge fund is uncomfortable. Electronics demand does not disappear because an analyst thinks the metal has moved too far too fast. Strategic manufacturing does not stop because bankers wish the price would cool down. That demand is stubborn. Supply is not. Most silver is not mined because companies wake up and decide they want to produce silver. A large share arrives as a byproduct of other mining operations. That means the supply response is slower and more rigid than people assume. Even if the silver price screams higher, new material does not magically appear next quarter. Mines take years. Permits take years. CapEx takes years. Refining capacity takes time. Political risk takes time. Labor takes time. Everything on the supply side moves slower than panic on the demand side. And markets do not wait politely for geology. This is why the phrase, "there are two prices," matters so much. A split like that is the market's way of saying the benchmark is losing authority. Paper is still setting the headline. Physical is starting to set the truth. Once enough participants realize the truth is elsewhere, they stop using the headline as their anchor. Then the benchmark has to chase reality higher, or it breaks its credibility entirely. Those are the only two endings. Either the official silver price rises hard to meet physical demand where it already is, or paper claims become less and less trusted until the market starts treating actual metal and financial exposure as two different species of asset. And if that second path accelerates, the consequences are brutal. Because the whole advantage of the paper market is liquidity, convenience, and scale. But if holders start suspecting that not all claims can convert cleanly into metal under stress, the premium shifts to certainty. In that world, an ounce you can touch is worth more than an ounce you can only reference. A serial numbered bar beats a line item on a statement. Allocated ownership beats pooled exposure. Delivery beats theory. That is already showing up in behavior. More people are asking harder questions. Is the metal allocated? Can it be redeemed? Who is the custodian? Can the custodian use sub-custodians? What happens if there is a settlement disruption? What happens if force majeure hits? What happens if I do not want cash? I want metal. Those questions were fringe questions when the system felt comfortable. They are becoming mainstream questions now. And here is where the move could get much more violent than most people expect. Silver has a history of looking sleepy right until it does not. It can spend months building pressure, frustrating both bulls and bears, and then suddenly reprice in a way that leaves everyone pretending it was obvious in hindsight. That is the personality of this market. Tight float, industrial necessity, monetary appeal, leveraged paper overlay, vulnerable shorts, thin confidence. It is the perfect recipe for price to move in steps, pauses, explosions, and air pockets. That is why the current spread across global physical markets matters so much. It is evidence that price discovery is no longer clean. And when price discovery stops being clean, volatility gets nasty. Now I want to be crystal clear on one thing. This is not about saying every data point is perfect or every rumor is gospel. It is about recognizing the pattern. Physical silver is commanding a premium that the official price is failing to explain. Deliverable inventory appears tighter than casual observers realize. Industrial demand remains strong. Supply flexibility is weak. Strategic control over refining and exports matters more than ever. And the paper market still seems built on the assumption that confidence will continue doing the heavy lifting. Confidence is not a metal. It can disappear. That is the whole danger. And once confidence starts eroding, people begin making different decisions. They stop renting exposure and start seeking ownership. They stop caring about theoretical liquidity and start caring about possession. They stop asking, is silver overextended? And start asking, can I still get it next week at anything close to this price? That shift is everything. So where does this go from here? If the paper market is forced to reprice toward the real-world physical market, then silver does not just grind higher, it can leap. What looks expensive on the chart today can look cheap in hindsight if the quoted benchmark has been artificially suppressing the urgency already visible in global retail and wholesale channels. A move into higher triple digits suddenly stops sounding insane if real metal keeps clearing far above the official benchmark and the spread refuses to normalize. Because markets do not reward disbelief, they punish late recognition. And that is why the people still laughing at physical premiums may be missing the most important signal in the entire story. Premiums are not noise. Premiums are information. Premiums are what the market says when the headline price is no longer enough to get the job done. They are the cost of certainty. They are the cost of trust. They are the cost of bypassing a system that may be promising more ounces than it can comfortably produce on demand. Ask yourself this: if nothing is wrong, why are real buyers around the world repeatedly paying so much more than spot? Why are spreads this wide? Why are people pulling metal? Why are immediate delivery signals flashing stress? Why does physical keep acting like it knows something the paper market is still trying to deny? That is not random. That is revelation. And revelation is dangerous for manipulated structures, because once the crowd sees the mismatch becomes the story. So no, this is not just another silver rally. This is not just momentum. This is not just retail excitement. This is a market beginning to separate price from value, benchmark from reality, and promise from possession. The paper market can survive volatility. It can survive headlines. It can survive speculation. What it cannot survive forever is a world in which too many people decide they would rather own silver than trust someone else's promise to find it later. That is the pressure point. If you already own physical, the key is understanding what you own and why it matters. If you do not own physical, then the premium you hate may actually be the message you need to hear. The market is charging extra for certainty because certainty is becoming scarce. That is not a bug. That is the signal. And if this trend continues, the window where paper price and physical price still appear connected could close faster than most people think. That is why this moment matters. We are watching a market test the authority of its own pricing mechanism in real time. We are watching physical silver vote against the official quote with actual cash. We are watching buyers in multiple regions ignore the screen and pay up for possession. We are watching a system built on leverage confront a commodity the world still genuinely needs. That is not a small story. That is the story. So watch the premiums, watch delivery, watch lease rates, watch vault withdrawals, watch what big players do with real metal, not what they say on camera. Because if this split keeps widening, then the silver chart most people are staring at will not be the roadmap. It will be the lagging indicator. And by the time the paper price finally admits what the physical market has been screaming, the easy entry may already be gone. Do you think the paper market catches up quietly, or do you think it breaks violently? Put that in the comments. And if you want more analysis like this, subscribe now, because the next phase of this silver story could move a lot faster than people are ready for.